Hello and a very warm welcome to Political Economy with Shweta Punj. You're watching Moneycontrol. Yet again, it's yet another volatile morning, and joining us today is a stalwart of the Indian financial landscape, Nilesh Shah, Managing Director of Kotak Mahindra AMC and member of the Economic Advisory Council to the Prime Minister, to help us make sense of the times, the volatile times that we are going through, not only from a market's perspective but from a national perspective in terms of how India should be navigating its vulnerabilities at this point, and most importantly, how should investors be looking at this volatile market. Well, clearly the Israel-Iran conflict has shifted from what once would have thought would have been a regional skirmish to a global energy and logistics crisis, and India finds itself at a crossroads today. So we sit down with Mr. Shah to decode whether India's growth oasis, as he's called it, can withstand the heat of rising oil prices, a volatile rupee, and the most precarious geopolitical climate we have seen in decades. A very warm welcome, Mr. Shah, and thank you so much for joining us. First up, I want to begin by asking you, how do you wake up every morning when you look at the markets and when you look at the statements coming in, not only from the United States but the geopolitical uncertainty that we are riding through? As someone who is advising people on wealth management, you are advising people on how to work the markets, how do we make the most of what we have. What are the big concerns that you wake up with every morning, Mr. Shah?
Thank you, Shweta, for having me here. Undoubtedly, we wake up every day with the burden of investors' dreams, aspirations, and expectations which they have placed with us. In a time as challenging as today, you go back to basics. You try to stay on the wicket rather than scoring runs. You go back to past experiences, analyze them, and try to find correlations with the current crisis. Our analysis of the past suggests whether it was Russia-Ukraine war, whether it was Operation Sindoor, whether it was Kargil war, or whether it was Gulf crisis in the past. By and large, markets bottom out when the first sign of war coming to an end emerges. And by the time actual war ends, markets have recovered most of the losses. Of course, each crisis is different. Number two, we also have to look at what is the material impact. As you know, share price is net present value of cash flow. It covers long future. Now, oil prices going up 3 months undoubtedly impact earnings, but that's only for 3 months. It's not forever. So you have to keep in mind the long-term objectives, long-term cash flows. And blending experience with your future projection, you try to remain as grounded as possible. This is the time to save wicket, not score runs.
All right, okay. We'll get you to talk a little bit more about that in just a bit, but I also want to get a sense from you, the fact that India is the world's third largest oil importer, and sustained conflict could push oil prices into triple digits. So how does that play out for, how India has worked out its math in terms of its fiscal projections, its current account deficit, and also is this making you relook at India's growth trajectory for 2026?
Undoubtedly, oil has various facets to impact our economy. One is the availability of oil. If oil doesn't come through at whatever price, then undoubtedly the hit on the economy is far higher. Number two is price of oil. As the third largest importer, we benefit when oil prices are low and we lose when oil prices are high. The third is the secondary impact of oil. For example, if gas is not available, It could have impact on fertilizer production, which could have impact on our food production. If crude is not available, it could have impact on petrochemicals, which could impact, polyester to plastics to other parts of the business. So undoubtedly, oil has multiple impacts on Indian economy. We have to evaluate first from availability of oil. Russia has already offered that they'll be happy to bridge the gap for India, but that does involve risk of US tariff. So
Right.
to some extent, I will say availability of oil will be less of an issue, albeit there will be consequences. Price of the oil is something which we have already seen going up. As you mentioned, there are chances that it can go into triple digit. Whether it will stay over there for longer period of time, then the impact on economy will be very high. Rupee, rates, inflation, fiscal deficit, everything will get hit. If it's a temporary, then at $725 billion reserve, we should be in a position to manage. So for Indian economy, we'll have to be watchful. What is the availability of oil vis-a-vis price of the oil, and also keep a watch on secondary impact of oil across industries. The surprising the surprising part, Shweta, if oil prices go higher, then ONGC benefits, and that results into higher earning per share of Nifty 50. Whereas higher oil prices passed on to the consumer or to the industry materially impacts NSE 500 earning. So even in various indices, impact of rising oil prices versus falling oil prices will be different.
Interesting, Mr. Shah. So, we've learned from the oil ministry that at the moment we have crude and petroleum product stock worth of about 50 days. Do you think that's enough time for us? That's the grace period that India has before high oil prices really start impacting our overall calculations?
So it's not just that these numbers will be static. Every day there will be ups and downs in the same. We have some long-term contracts, some market contracts. So to get the feeling that we are in complete control of data and numbers will not be appropriate. As event changes, we'll have to change our view. For us, availability is far more important than the price. Of course, higher prices hurt us, but we should be able to bear that pain. Non-availability is a far bigger risk.
So, what do you think? Here we are in a bit of a rock in a hard place kind of a situation, because on one hand we have President Trump telling us in as many words that we should not be taking oil from Russia. And then you have the oil supply situation that is clearly hitting us. Having said that, India has not come out and agreed very explicitly with Mr. Trump. We've seen the American side make statements on India agreeing to not buy Russian oil. We've not heard that from the Indian side. So, as a part-time member of the Economic Advisory Council, Mr. Shah, how do you see this playing out for India? What is your sense, and what India should be doing in a situation like this?
See, our government has been very clear. We will do what is in the interest of India. And I think we should trust our own government rather than trusting outsiders. Outsiders will share truth from their point of view. We need to see truth from our point of view. In diplomacy, many a times things need not be stated. It should be understood. And undoubtedly, Russia is our long-term partner. We depend upon them for defense. We depend upon them for, UN Security Council voting. So undoubtedly, our government will take steps which will be appropriate for India. Instead of relying outsiders, I think we need to have confidence and trust in our own government.
And how are you reading into the LNG situation, Mr. Shah, considering force majeure notices have been issued by a slew of companies that that have been supplying LNG into the country? Do you see that as a big overhang on India at the moment?
Undoubtedly, it will be an overhang. As I mentioned, price we will be able to afford at $725 billion reserve. Availability is something which we can't afford. LNG is hit because of force majeure at Qatar, one of the largest LNG producer in the world. Obviously, priority goes to consumer rather than industry, and which is where we have seen force majeure being announced by some of the LNG supplier to the industry. It will have impact on industrial production from fertilizer to power, and there will be consequences for Indian economy. Now, the real challenge is it a 1 month window? Is it likely to be longer term window? Now, there are conflicting news on what is constituting a closure. Is it driven by drone attacks or threats by Iran? Or is it driven by insurance companies pulling back the cover? If it is largely driven by insurance companies pulling back the cover, then President Trump has already announced that he has instructed US institutions to provide insurance cover. Now we'll have to see how events shape up. We are not the only country which will be impacted by closure of Hormuz Strait. There are other countries also which will be impacted adversely. And hence, there will be global pressure on opening up of Hormuz Strait, be it on
Right.
insurance companies, be it on Iran.
And how do you see this uncertainty play out in the markets if the conflict continues for longer than expected? And how would you rate the Indian equity markets as compared to, say, what we are seeing in the United States, or even for that matter Israel or the other emerging markets? Do you see India as a safer story as compared to the rest of the world at the moment, or do we see markets like the one in the US benefiting from the war, and this is where we see FII and FPI outflows picking up and going back to the US markets?
So, undoubtedly, FPIs had turned buyer in the month of February before the war broke out. Their selling intensity had come down and buying intensity had increased. Now they have been selling again because of the concerns related to war. India is the third largest importer of crude, and as crude prices go up, undoubtedly FPI selling should continue. We believe passive FPIs will be net buyers as emerging markets continue to receive flows despite the war and uncertainty. Active FPIs could be seller because of the concerns on Indian economy and the valuation. Everything depends upon the tenure of war and severity of war. If the war becomes like Russia, Ukraine, where once in a while something happens, but it has no material impact on availability or price of resources, and there are alternates emerging, then people will stop bothering about what's happening between Israel, US, and Iran. But if it continues to be severe, impacting Hormuz Strait, impacting availability as well as price of raw materials, then obviously market will take that into account. Markets have corrected by 5 to 6%, keeping in mind this uncertainty. If the tenure or the severity of war increases, undoubtedly there will be more correction.
So do we see investors favoring the US markets and the more developed markets more if the war continues? And when we say it continues, what's the grace period, the grace window that you're referring to? Is it next 2 weeks? Is it next 2 months?
I don't think so. We are in position to indicate any grace period. Everything will depend upon the events. We have to play the ball on its merit rather than predetermined. US market, again, there is a cost of war which they have to bond. the benefits will go to defense companies, but other companies will have to pay the price. Fiscal deficit will be higher, borrowing will be higher, inflation could be higher because of supply disruption, and there will be a price to be paid by others as well. So, overall, if we see, the FPIs will be watching events just like we are watching. There is always flight to safety, which benefits US market. But it's not that there is no cost of war in US. They also have to pay the price.
Right. And what's your outlook on the rupee, Mr. Shah? Do we see the rupee, and do you think there's scope for the RBI maybe to, at which point should the RBI intervene really to arrest the rupee? And do we see a
The
situation like
RBI,
that playing out?
we believe rupee will remain weak. The RBI should follow their time-tested policy of letting the market decide the direction and intervene only for controlling the volatility. Market knows that RBI is short forward. They have $725 billion reserve, but they also carry a short forward position of about $70 billion, give and take 5% here or there. In that kind of scenario, higher oil prices impacting deficit, higher oil prices impacting inflation, and higher oil prices adversely impacting growth, probably resulting into FPI outflows. So it's a perfect storm for rupee. Higher deficit, higher inflation, higher FPI outflows, RBI short forward. Undoubtedly, rupee will tend to depreciate. And RBI should let market find its own level rather than trying to defend a particular level. They should intervene only to control volatility. So rampant speculation does not determine rupees prices. Let the fundamental determine rupees price. We think rupee has still scope for depreciation.
Okay, and do we see this clearly hurting India's growth prospects? Do we see this as clouding, as India being a big positive growth story in the world? We've been hearing about it, we've been talking about it ourselves. But and at the start of the year when we spoke, Mr. Shah, you did speak about India being an oasis of growth. Do we see that story continuing for 2026, or or has that changed now? It's going to be harder than we had anticipated for it to be.
Undoubtedly, the pitch has become bad. There will be marginal adverse impact on our growth rate if this war persists. Uh, do we have the ability to withstand some amount of price hikes? Undoubtedly, yes. Do we have reforms process which can negate the adverse impact of higher oil prices or lack of availability of crude? Answer is undoubtedly yes. So I still believe that our long-term growth story is not impacted. However, have we hit a speed breaker? Answer is yes. Will it slow down us a little bit? Answer is yes. But will it result into a pushback and U-turn? Answer is undoubtedly no.
Okay, so this is a bit of a multiple whammy of sorts playing out, right? We've had higher tariffs, and now we have this geopolitical conflict and geopolitical tensions that are really that will really impact Indian businesses, specifically the MSME space. I want to get a sense from you on how do you see the AI story also playing out for India? New Delhi, India hosted the India AI Impact Summit, where we also got to learn about all that's happening in the world where AI is concerned. And while India has made tangible progress on that front, but looking at the way the IT sector has been getting hit every day on the equity markets, also the kind of job losses that we see coming out from there. Do you see that playing out for the rest of the year, Mr. Shah, or do you think that's again a temporary situation, and the AI overhang is something that India should be able to overcome?
I think the bigger factor for us is not the Middle East crisis, but the AI and its impact on Indian economy. Between BPO, KPO, GCC, and IT services, About 4 crore Indians are directly or indirectly employed in that sector. This sector collectively gives somewhere between 300 to 350 billion dollar of FX revenue or remittance. That's a substantially large percentage of our economy. This IT sector employees are also consumers of real estate, automobiles, consumer staple, and so on and so forth. Any adverse impact on IT sector in terms of growth, profitability, employment will have far bigger reaching impact on Indian economy. Today, we are seeing a stage where there could be either opportunity of lifetime or risk of a lifetime. When we go to IT company, they say, look, we transited from Y2K to application development, programming, infrastructure management. Then we moved to consulting. Then we moved to data security, cloud computing, and so on and so forth. We will do this AI transition as well. When we go to global AI developers, they say programming is becoming passe. Now, cloud or AI will be able to compute, and there's no need for software developer. When we come back to IT company, they say, look, software programming is just 20% of a developer's job. There is 80% related to understanding client's problem, finding a workflow, creating solutions, monitoring solutions, protecting data, and so on and so forth. Do we have people who are leveraging AI? Answer is undoubtedly yes. We don't have the highway of LLM, but there are many people who are building apps utilizing that LLM. If Indian IT companies capture that opportunity, which is, let's say, available in enterprise AI, to leverage AI, you require data. Data is scattered all over. Data needs to be stored, analyzed, protected, and accessed. This itself could be as big an industry as India's current IT industry. This is opportunity of lifetime or a risk of a lifetime. And today we don't have definitive view. We'll continue to watch how our Indian IT companies evolve. One thing we surely believe, there will be winners and there will be losers. Every single company is saying we are leveraging AI. Some will leverage better and they will go and capture the opportunities. Some will not be able to race as fast in this race and they will be loser. So it's going to be bottom-up stock selection, but on a top-down basis, keep observing events just like you are doing it in Middle East right now.
And how long do you see this pain in the IT space to continue for? Or is it very difficult to put a timeline on it, and it completely depends on how companies are adapting and embracing AI and leveraging it?
The events are happening at a much faster pace. Opportunities are emerging and also, risks emerging. I think this is not the time where you can have a definitive view. You'll have to keep on observing how things are shaping up, keep on reading and listening to wise people, and then form a view.
How about, and what's your outlook on the Indian pharma sector, Mr. Shah, considering, Indian pharma relies heavily on the import of key starting materials, which are currently disrupted because of the tensions that we are seeing in the Middle East. What's your outlook on that?
So, at least compared to other parts of the economy, Indian pharma is reasonably secure. The APIs are mainly coming from China, and availability of APIs at this point of time doesn't look disturbed. Second, many Indian companies have started going into APIs. For example, one of the Indian companies started making penicillin G, the basic API, after almost 3 decades. So Indian companies are integrating backwards. Their challenge is more in terms of biosimilars and some of the newer trends which are emerging on the pharma and healthcare. On the generic pharma side, I think Indian companies continue to play an active role. Their cost competitiveness remains very, very high. So overall on pharma, we are reasonably constructive. As income level rises in India, incremental spending will be towards education and healthcare rather than roti kapda. So pharma, we remain constructively positive.
Okay, and you've always been a big believer of the India consumption story. Do we see that changing in 2026, considering we have high freight costs, we have a weak rupee, we have inflationary concerns? Do you see that hurting the India consumption story, specifically rural consumption?
Rural consumption will depend a lot upon how monsoon behaves. There is pressure that El Nino is building up, while the actual confirmation will come in the month of May. The omens are not good. So we'll have to wait and watch how monsoon is going to behave. The current indications are that while El Nino is building up, it's more likely to impact August and September rains rather than June and July rain. July rains are most important for Indian economy, for Indian agriculture. So rural economy likely to be impacted by how El Nino behaves and how it impacts monsoon, much less to be impacted by what's happening on the Middle Eastern side. The urban consumption undoubtedly is linked to IT sector and also what happens in the Middle East. There are 9 million Indians working in Middle East and giving remittance to India. That will be a couple of tens of billions of dollars. Those flows should continue to support both urban as well as rural consumption. Overall, we still think that if oil prices are hiked temporarily, government will take the fiscal hit rather than pass it on to consumer. However, if it persists for a longer period of time, then only consumption will get hit.
Okay. And Mr. Shah, as a member of the Economic Advisory Council to the Prime Minister, what are the policy levers that the government has at this point? We've had several conversations on universal basic income and so on. So with every crisis, there are a lot of suggestions that one gets on what the government can do to protect the Indian economy, to safeguard the interests of those that are affected very adversely. But in a situation like this, it's a very unenviable situation, really. Are there any policy levers that the government can deploy to soften the blow somewhat on the Indian economy?
Undoubtedly, government will have to take the lead. And there are a couple of options available. India is one of the few countries where 150% of GDP is locked in precious metal. These are savings frozen in Tijori. They don't benefit Indian economy. We go out all over the world to get 2% of our GDP as gross FDI, and we are keeping 150% of our GDP locked in our Tijori. If we can monetize that frozen savings, undoubtedly economy has more firepower to manage volatility. The second is ease of doing business. A small country like Bangladesh exports $30 billion of garments to European Union. We export about $3 billion. There was a 12% import duty levied by EU on Indian imports. Now that's going to become zero, probably somewhere from 2027 beginning. Can we encourage textile industries to go and capture those opportunities which we have missed so far? Same thing is possible in aquaculture, same thing is possible in many other industries. And finally, the reforms which are required to push economic growth into next orbit. It could be divestment of government assets which are not productively used. It could be improvement in ease of doing business further. It could be encouragement to research and development through RDI fund. So there are many options available with the government. A lot of them are being worked upon. And like we have seen when US tariff was raised, there was fear that Indian economic growth will be adversely hit. Undoubtedly, some sectors got hit like textiles, aquaculture, gem and jewelry. But rest of the economic reforms, rest of the economy benefited from the reforms. So government has multiple options at their disposal. A lot of them are being worked upon. And I see undoubtedly there will be pain of Middle Eastern conflict, but we have the ability to bear the same.
And what's your sense on the fact that we we are actually we have multiple relationships here to manage as well, right? We've been standing, we've taken a fairly neutral stance. Is that how India should continue, or according to you, should we be seen aligning with one camp over the other, depending on where our interests lie?
It's beyond my pay grade. I'm not an expert on foreign relationships, external affairs, or military. We should do what is in our interest. There are 9 million Indians working in Middle East. Their safety should be our priority number one. Their remittance continue to empower our economy. We should do everything possible to protect the same. The Middle East provides a fair amount of our energy supply. We should ensure that that energy remains available to us and at a reasonable price. This should be our top three priority: protecting 9 million Indians, ensuring that their remittance continue, and ensuring availability of energy supply at reasonable price. Everything we do should be keeping in mind these three objectives.
Okay. What are the growth numbers that you are working with, Mr. Shah, for this year? And what advice would you have for investors, who are struggling, trying to make sense of this market? How should they diversify across equity, debt, and precious metals really to survive the noise?
So one, mentally be ready for volatility. There will be ups and downs as events unfold. We have no ability to predict event. Only thing we have in our control is to behave or react after the events have happened. Second, we should remember from past experience, markets generally bottom out before the war actually ends. This is more like trying to discount the future. Third, asset allocation is the right way to manage volatility. Our view on precious metal, both gold and silver, remains positive. We don't expect them to deliver return like last year, but they should still deliver positive return considering the global uncertainty. On the fixed income, it's time to be in the short duration. The inflation could be higher, fiscal deficit could be higher, rupee could be under pressure. It makes sense to cut duration and be at the shorter end of the curve from a carry point of view. On equity, there will be ups as well as down. Markets are discounting the events, and hence, whenever markets fall, you can probably look to add a little bit to your exposure. This is still a fair value market, not cheap, not expensive. So maintain neutral asset allocation, bit overweight towards large and mid cap, bit underweight towards small cap. Don't try to put everything at one go. If there is a positive news, there will be ups and downs in the market. So try to invest gradually in a calibrated manner during correction.
Okay, so gold or equity for the next 6 months. So what is it that what's your bet?
Both, you need to have balance between gold as well as equity. You can't put everything in gold, even if your view is positive, because gold does not have intrinsic value. It's a play on central bank buying. It's a play on global uncertainty. So both needs to be part of your portfolio. It's not either or, it is and.
So this is physical gold, or it could be gold ETFs, anything.
So never ask a barber whether you need a haircut or not. As a mutual fund manager, I will always say gold ETF. It takes away, the transaction cost. You go and buy small quantity of gold, physical gold. Charges are far more compared to gold ETF. We also, have much better security custodial arrangement thanks to our custodian. They store gold in earthquake-proof structure. There is 24 by 7 monitoring. It's also backed by insurance policy. So compared to an individual buying small quantity of gold, gold ETF will be appropriate.
Okay. And one sector to overweight despite the war?
Uh, One sector where we believe there could be opportunity is banking and financial services. The deposit rates have been repriced. The advances have been repriced. Now deposits going forward will get repriced. Even if there is some upward movement in interest rate, that should be first passed on to the borrowers. The banking NPAs are under control, valuations are reasonable, and they should benefit by way of margin expansion in next year. So banking and financial services looks an attractive sector from current situation.
All right. And what, according to you, is the biggest threat for India? Is it oil crossing $100 a barrel or FII selling?
See, FIIs will sell if our fundamentals deteriorate. If our fundamentals improve, then they will come back. So we should be focusing on our fundamentals, which can be adversely impacted by higher oil prices. But more than the oil prices, it is the availability of oil which we need to focus upon. Second, of course, is IT industry and impact of AI on IT industry. And finally, the third thing which we need to focus upon is the complacency. Events will happen, they will move our economy, they will have impact on our economy. We can't be complacent about it. And we should continue to push reforms so that the adverse impact of such events have minimal impact on our economy.
And on small caps, Mr. Shah, buy the dip or wait?
Wait, there is still a higher valuation on small cap. They'll be most vulnerable to global shocks. So maybe this is time to wait and watch rather than jump in.
All right. I think that's a fairly comprehensive overview of how investors need to be hedging. Very quickly, Mr. Shah, if you were to summarize the three big priorities for the government at this point to give confidence to the investors, to give confidence to the private sector that will be creating jobs, what, according to you, should they be?
Push reforms for improving further ease of doing business. Second, think about how to monetize frozen savings in Indian Tijori. And finally, uh, keep India first policy when we negotiate with the outside world.
And how much of a worry is the pay commission payout that's coming up, Mr. Shah, in the next few months, in the next 8-9 months or so? How much of a worry is that for you? Because again, that would mean a big outgo for India. We anyways have a lot of subsidy payouts that are frozen. So, is that a cause of concern for you?
So to some extent, if those payouts result into increase in domestic consumption, it will be supportive for growth, and that money will recirculate back in economy. Uh, Undoubtedly, there will be impact on fiscal side, and which is why this money should be spent on Swadeshi goods and services rather than foreign goods and services. If entire pay commission hike is spent on buying Apple phone, then US benefits. But if it is used for buying India made goods and services, undoubtedly India benefits. So pay commission is something which is well known to the market, that's well discounted, and it's unlikely to have a material impact.
All right. Okay. And my last question, your one word on how you would describe the markets for the next maybe 3 weeks or so, and how should investors be approaching this with caution, with cautiously optimistic outlook, or with a lot of careful consideration?
It's a fifth day pitch in an overcast condition. We have to hope and pray sun will come out and take away the overcast condition. Play the ball on merit. Saving the wicket is more important than scoring the runs at this point of time.
Okay, so by how long should we wait for before we start scoring the runs again?
When the sun comes out, start hitting the ball.
Okay, when the sun comes out, but we don't know when the sun will come out. Or are you optimistic that the sun will come out? No?
Undoubtedly, yes.
Okay, all right.
Undoubtedly, yes.
Okay, okay, all right. So, on that optimistic note, that the sun will shine on us again. So, it's not all gloom and doom. And India, with its many challenges, continues to be a bigger and a better story than many parts of the world. So, thank you very much, Mr. Shah, for really a very insightful analysis of how investors should be treading this market, and most importantly, the policy prescriptions also for the government at this point. Well, it's not all gloom and doom, and I think that's a good note to end the show on. A big thank you to all our viewers for tuning in. Do leave us your comments in the comment section below. Thanks so much for watching. We'll keep tracking this story right here on Money Control.